What if I told you the 2008 financial crisis wasn't a random storm, but a carefully engineered heist? It wasn't just a market crash. It was a scam that shattered the lives of millions and permanently broke the middle class. And the craziest part? The architects of this disaster walked away richer than ever, while ordinary people lost everything. Today, we're pulling back the curtain on the biggest financial fraud in modern history. Forget what you think you know. This wasn't about a few bad apples. It was a systemic rot that infected the entire global economy. To understand this heist, we have to start with something seemingly simple: a mortgage. For decades, getting a home loan was a straightforward process. You needed a good job, a solid credit score, and a down payment. Banks were careful because if you couldn't pay, they were stuck with the loss. But in the early 2000s, Wall Street had a brilliant and devastating idea. What if they could make money from mortgages without taking on any of the risk? This single question lit the fuse for a global economic bomb. The plan was called securitization. It sounds complicated, but the concept is simple. Banks started bundling thousands of individual mortgages together into a package called a mortgage-backed security, or MBS. They then sold slices of this package to investors all over the world, like pension funds, city governments, and other banks. The pitch was simple: buy this, and you'll get a steady stream of income from all the homeowners paying their monthly mortgages. It's as safe as houses. And for a while, it worked. The demand for these MBS products exploded. Everyone wanted a piece of the American housing market. But this created a new problem. Wall Street needed more and more mortgages to feed this hungry machine. The supply of creditworthy, prime borrowers was running out. So they turned to a new, much riskier market: subprime mortgages. These were loans given to people with low incomes, poor credit, or no down payment. Before, banks would have never made these loans, but now they didn't care. Why? Because they weren't holding the risk anymore. Their new business model was to approve as many loans as possible, package them up, sell them off, and collect massive fees. The risk was now somebody else's problem. This created a lending frenzy. Loan officers were incentivized to sign up anyone, regardless of their ability to pay. We saw the rise of so-called ninja loans: no income, no job, or assets. People were getting mortgages for $500,000 by simply stating their income, with no proof required. Lenders offered deceptive teaser rates that started low, but would balloon to unaffordable levels after a couple of years. The system wasn't just encouraging risky behavior. It was manufacturing it on an industrial scale. These weren't just bad loans. They were toxic assets. Financial time bombs waiting to go off. So how did Wall Street sell this garbage to the world's most sophisticated investors? This is where the scam gets even more outrageous. They needed a seal of approval, and they got it from the institutions everyone trusted: the credit rating agencies. Companies like Moody's, Standard & Poor's, and Fitch were supposed to be the independent referees of the financial world. Their job was to analyze investments and assign them a rating, from the ultra-safe AAA to the super-risky junk status. But there was a fatal conflict of interest. The banks selling the mortgage securities were the same ones paying the rating agencies for a rating. It was like a student paying their teacher for a grade. If one agency gave them a bad rating, the bank would simply go to a competitor who was willing to be more flexible. So, the agencies started a race to the bottom. They stamped these bundles of toxic subprime mortgages with the highest possible rating, AAA. This was the same rating given to ultra-safe U.S. government bonds. It was a blatant lie, a stamp of approval bought and paid for. This AAA rating was the magic ingredient that made the fraud possible. It tricked investors worldwide into believing they were buying a rock-solid, safe investment, when in reality, they were buying a portfolio of junk. With the rating agencies on board, Wall Street's greed went into overdrive. They invented an even more complex and dangerous product: the collateralized debt obligation, or CDO. Imagine you have a pile of those risky mortgage-backed securities. You take the riskiest, junkiest parts, the slices that were already rated poorly, and you bundle them together into a new security, the CDO. Magically, by slicing and dicing these junk assets in a specific way, the banks convinced the rating agencies to label most of the new CDO as AA or rated. It was financial alchemy, turning lead into gold. They were taking literal garbage, repackaging it, and selling it as a premium product. But it gets even crazier. Wall Street then created something called a synthetic CDO. These weren't even backed by actual mortgages. They were basically side bets on whether the original CDOs would fail. It was like buying fire insurance on your neighbor's house and then betting on it burning down. The financial system was no longer connected to the real world of people paying their home loans. It had become a global casino with trillions of dollars wagered on these abstract synthetic products. The entire system was now a house of cards built on a foundation of lies, greed, and toxic debt. The only thing holding it up was the belief that house prices would keep rising forever, and then the inevitable happened. The housing bubble, inflated by all this easy money and fraudulent lending, began to burst. It started in 2006 and gathered speed in 2007. The low teaser rates on those subprime mortgages began to reset to much higher, unaffordable rates. Millions of homeowners suddenly found their monthly payments doubling or tripling. At the same time, house prices started to fall. This was a death blow. People couldn't afford their payments, and they couldn't sell their homes because they owed more than the house was worth. Foreclosures skyrocketed. All those toxic mortgages that were supposed to be paying out to investors started defaulting in massive numbers. The rated securities weren't safe at all. They were worthless. Panic ripped through the global financial system. The CDOs, the synthetic CDOs, they all collapsed. Banks that were loaded up on these toxic assets suddenly realized they were sitting on a mountain of losses. Lehman Brothers, a 158-year-old investment bank, went bankrupt in September 2008, triggering a full-blown global panic. The casino had gone bust, and the entire world was about to pay the price. The fallout was catastrophic. The credit markets froze. Banks stopped lending to each other, to businesses, and to individuals. The global economy ground to a halt. But the real victims were not on Wall Street. It was the middle class. Millions of people lost their jobs as the economy plunged into the worst recession since the Great Depression. Families who had spent their lives building up equity in their homes saw it vanish overnight. Their single biggest source of wealth was erased. Retirement savings, invested in what they thought were safe funds, evaporated. This wasn't just a financial loss. It was the destruction of the American dream for an entire generation. The promise that hard work and responsible homeownership would lead to a secure future was broken. The gap between the ultra-rich and everyone else widened dramatically. While Main Street was suffering, the government bailed out the very banks that caused the crisis, declaring them too big to fail. In a final cruel irony, many of the same executives who engineered the fraud received massive bonuses paid for with taxpayer money. Not a single high-level executive went to jail for the fraud that wrecked the global economy. The legacy of this fraud is still with us today. It created a deep and lasting distrust in our financial and political institutions. It showed us that there's one set of rules for the powerful and another for everyone else. It's why so many people feel like the system is rigged against them, because in 2008, it was the wealth that was wiped out for the middle class has never fully been recovered. This event changed the economic landscape permanently, contributing to the financial insecurity and political polarization we see all around us. Understanding the 2008 mortgage fraud isn't just a history lesson. It has a blueprint for how greed and a lack of accountability can corrupt a system and destroy lives. It's a reminder that we must remain vigilant, ask tough questions, and demand accountability from those in power. Because when we forget the lessons of the past, we are doomed to repeat them. The story of 2008 is a story of a heist, where the wealth of a nation was stolen in broad daylight, and the getaway car was a government bailout. Thanks for watching. If you found this breakdown insightful, be sure to hit that like button and subscribe for more deep dives into the mysteries of our modern world. Let us know in the comments what other historical events you'd like us to expose. See you next time.